I think, though, the dynamics of the oil market are very clear that we're going into a deficit situation into the end of the year. And effectively, prices are structurally higher for a time, at least until the US can start dropping more oil or deliver more oil into the refining hubs in the US and also into the Gulf, because they're pipeline constrained. We think that the capacity will start to ramp up around mid next year, but there are risks around that. And also the point would be that Saudi Arabia has increased production. It's getting close to 11 million barrels per day.
Yeah.
Any additional capacity being used above the 11 million barrels per day is largely untested. On a historical basis, we have not seen Saudi Arabia produce more than 11 million barrels per day. So we're moving into that uncharted territory. Russians have also increased production around 200,000 barrels per day, but we're basically spent. So the market is going into what is a deficit situation where spare capacity is low in OPEC, and at the same time we have these geopolitical risks which are creating this sort of volatility in the market. So my view would be, so we've been targeting $85 a barrel for about
Brent?
four or five months now.
For Brent?
And when we look at the spreads to some of the US oil hubs, those spreads are still quite wide, which indicate that trapped oil sitting in the US. But not only that, but all we need is, let's say, an outage in Libya, a material outage in Libya, something happens in Nigeria, effectively you've got oil prices above 90. So it was interesting, the backwards and forth between Trump and the Saudis over the last few days, where the Saudis were very quick to come out and say, you know what, oil prices can go to $100, yeah. But irrespective of all of that noise, the deficit situation is severe enough going into the end of the year. It's going up regardless.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.